Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to estimating financing needed for an increase in assets. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 613 Estimating Financing Needed for Increase in Assets tab in the Practice Problems section. Closing this back out, we're going to go through our information up top, then we'll have a smaller section of our information that we can then use to work through the practice problem. So we have the expected sales in our data, that's going to be the 500,000. There's going to be an expected increase in inventory and accounts receivable. Now note that if there's an increase in sales, that could result or be the result of an increase in the assets. So if there's an increase in sales, for example, we might then expect there then to be an increase in the accounts receivable as a result of that increase in the sales for the sales that are on account, and possibly need an increase in the assets in order to accommodate an increase in sales. So once we have an increase in the assets, we then need to think about how we're going to finance those assets. Now we might be financing those assets with the revenue generated from the sales, of course, but at the same time we could be paying some of those out. It depends on how much we're going to be paying out in terms of dividends as well, to think about how we're going to be financing that increase in the assets. So as we go through this, we think an accounting equation. We've got the assets increasing, then how are we going to be dealing with the financing of those assets, either through the liabilities or equity. The increase or the sales item would then be leading to net income, which would be part of what would be increasing on the equity side of things. But we also have to take into consideration what will be paid out in the form of dividends. So then we have the profit margin, which we're going to say is the 16%. That's going to help us to calculate what the bottom line number will be for the increase in equity on the net income side of things. Then we have the dividend payout, which is fairly high here at the 40%, meaning that's how much we're going to take of the net income and pay it back to the owners. So whatever the net income is, we're going to take 40% of it, give it back to the owners. That means that the net increase on the equity side of the equation is going to be reduced by the amount of that net income that we didn't simply keep in the company to finance the increase in assets, but gave to the owners in the form of a dividend. So how much added financing will be needed then in this scenario? We will assume no increase in liabilities other than the amount related to the external financing that we're going to put into play. So we're focusing here on, do we need more financing on the liability side? So if we think about our accounting equation, which is assets equal liabilities plus equity, remember that we're thinking that the assets then are going to be increasing. We have an increase in the assets, and that's going to be this 85,000 increase in the inventory and accounts receivable. And then we got to think, well, how are we going to finance that? Is it going to be liabilities or equity? Once again, that increase in the assets may be due to a spike in, say, sales. Sales might be higher than normal, increasing the need for, or increasing the accounts receivable related to the sales on accounts and possibly the inventory. And that could be covered by, of course, the net income that would be generated from that activity. But then again, that would be equity financing it. But the equity then could be going down due to the dividends that we're going to be paying out, which is fairly high. We're going to be paying out 40% of the earnings we have in the form of dividends. Therefore, is there going to be needing any more financing here on the liability side in order to support this scenario? So to do that, let's first think about basically our net income type of calculation. We're going to be taking the sales, which we said was the 500,000 in our data up top. They gave us the profit margin. So we're going to then multiply times the profit margin, which is the 16%. The 500,000 times the 16% will then get us to the net income bottom line number. That's going to be the 80,000. So now we have the 80,000. Then that's going to be the increase on the equity side of the equation over here. But then we're gonna have to decrease that equity side of the equation, and notice the assets over here are the 85,000, increasing on the equity side of things, the 80. But then we're gonna have to pay out the dividends. This is the amount of the net income, the earnings that we're gonna be paying back to the shareholders, and that we have a dividend payout of 40%. So that 80,000 times the 40% means that we're gonna be paying dividends to the shareholders of 32,000. 32,000 of the dividends will be paying out to the shareholders. Therefore, we have the increase of the 80,000 minus the 32,000, net income minus dividends, giving us a net increase of the 48,000. So if we think about the assets are going to go up by the 85,000, and the equity is going to be taking care of the 48,000 of that in order to finance that increase in the assets. The rest will then need to be financed with liabilities, right? So we're going to have to think about that. We could see it in the equation here. If you were to put it into kind of a vertical type of layout, we would say that the increase in assets was the 85,000. We're going to subtract out the increase in the retained earnings, net increase. That's going to give us then what we need for the external funds that are going to be needed, which of course is the liability side, or that's 37,000 in this case. Now, as we think about this going forward, we want to start thinking about this liability side and thinking about how we're going to finance these items. And we're going to be kind of breaking out between short-term financing and long-term financing. And so to think about that, we got to see, well, what's going to be our needs? How long are we going to have the loan needs? And then, of course, the terms on the interest terms and the cost of the financing, as well as risk that could be associated with having something like a variable rate versus a fixed rate, or a short-term loan versus a long-term loan. So we'll start thinking about those options in the future. And in order to do that, we'll start thinking about, these types of assets that we're going to be increasing to finance, and thinking about whether those are long-term or short-term. But let's do this again. We'll do this example again here. So we have the expected sales of the 3 million this time. The expected increase in inventory and accounts receivable is 420,000, and then the profit margin is going to be the 22%, the dividend payout 45%. How much added financing will be needed? We will assume no increase in liabilities other than the amount related to the external financing. Here's a shorter breakout of this. Once again, we have our accounting equation. We have the assets then increasing by this 420,000. Again, that asset increase could be a result of sales increase. It could be a result of good times happening, sales then going up, and that would increase naturally the receivables, which would then be spiking as the receivables roll through the balance sheet before we collect on them, and possibly inventory, so that we have the inventory necessary in order to accommodate an increase in the sales items. Now, how are we going to finance that? It's either going to be with liabilities or equity. If sales increases, then we would think hopefully we finance it with the equity. But the net income that we're generating might then be going down, of course, with the dividend payouts. We might have the dividends payout, and so we have to determine if it's going to be financed with equity. If it is not, then we may need to finance it with a liability. If we finance it with liability, then we want to consider, the type of financing that we might take on, short-term, long-term, what the rates might be, and we'll consider that in more depth in future presentations. So we'll then take a look at the net income. Net income is going to be the expected sales of the 3 million. We then have the rate, which is the profit margin of the 22%, bringing us down to the net income. So we think the net income is going to be 660,000, which would take care of our asset increase. However, and that's what the equity side would be going up by if we didn't have the dividends, but we do have dividends, and we said that we're going to be giving out the dividends of the 45%. So of the net income, we're going to be giving out dividends of 45% to the owner. That's going to be the 660 times the 45%, or dividends of 297,000. Therefore, the increase in the equity is going to be the net income, 660,000, minus the dividends. We're going to pay out the 297,000 for an increase in retained earnings of the 363,000. And that's going to be on the equity side. So now we've got our assets increasing by the 420, possibly due to an increase in sales, which increased the accounts receivable and increased the inventory. We are going to be generating revenue, but we're going to pay out the dividends, leaving us with only an increase in the equity of the 363,000, meaning the difference has to be taken up by the liabilities, which you can calculate here. We'll do it in a vertical fashion as well. The increase in the assets being the 420,000, we're going to finance that in part with equity, the 363,000. The other is going to be financed with liabilities, the 57,000. That's going to be the other side of basically our accounting equation. Now, once again, we're going to then continue on with this in future presentations and think about our financing options, breaking them out in general to like short-term and long-term type of financing options, and looking at strategies in terms of how we would determine how much to finance with short and long-term, what are the pros and cons of doing so.